Is it all right if I stay here, Mr. Chairman? Thank you. Well, it's good to be here. It's the senator from Massachusetts, home of the world champion Red Sox. I have a few questions. I hope I work that in subtly. But we've been talking about the 10% upfront first loss money ahead of the guarantee and whether or not that part is right. But the question I want to focus on is the back end. That is, when is the guarantee triggered? Because I think that's also very important. And we have two financing models that we've talked about in S1217. And one is the bond approach or mutual approach that you were talking about, Mr. Tracy. But the other is the structured transaction. And so what I want to focus on is the difference in trigger between those. So as I understand it, one would think in a structured transaction, what we may be doing is every time any particular transaction runs beyond the 10% first loss money, then the government's in the position of writing a check, which would mean, if that is so, that the government is in the position of writing checks long before there's any systemic risk, but really just backing up a bad deal. The flip side of that is in a big bond approach or mutual approach, it's a long time before you see 10% of the first loss money disappear, and that may mean that the government is coming in only long after the market has begun to crater and we have serious systemic problems. So I think of this kind of like a Goldilocks problem, too hot or too cold in terms of the government intervention. So the first question I want to ask is about how we get the dial between those two. Is there a way to do it? And then go to the implications of that. Mr. Stevens, you were nodding. Would you like to comment on that?
Well, I think you're raising an important point, and at the highest level, we agree with your premise. And that's why having various types of options in place for the credit enhancement component, we keep in mind before the government, the taxpayer gets affected by this, you have the borrower's equity, you have the first loss credit enhancement, and then you have the guarantor who's there, and then finally you have the federal fund at the regulator level. So all of those have to be pushed through in order to ultimately get to a loss to
right,
taxpayer.
Which is just a way of saying we hope we're never going to be there.
That's right.
But when you sit on this side, you've got to write the law in the fear that we're going to be there someday.
That's right.
That's the point here. So the question is, what's the right trigger? Should we be backing up every deal?
I think ultimately we have to separate the backstop on the MBS itself versus how we structure the credit enhancement within the transactions themselves. And I think keeping that dialogue separate is important, right? So the 100% guarantee on the mortgage-backed security for whatever framework of loans are allowed for within this new guarantor model, that'll frame in the size and scope that the government's role plays in this new entity. But once you get past that, we think there needs to be a variety of competitive structures on the credit enhancement model itself. So you can't do just solely senior substructures, for example, in this new model. We think there needs to be multiple entities as well, because a single entity can create this too big to fail approach in the cooperative model. So
I'm still trying to work through that, because I certainly understand. That's why I said it's a too hot, too cold problem. I understand that part of the problem. But here's my concern. I don't know how these things can exist in the same universe, in the sense that if I were an investor and I knew that investing in structured transactions would get a quicker trigger in terms of when the government has to pay, then those will be priced differentially, right?
I don't think
everyone will bleed in one direction. You don't think they will go that way?
There's no reason for the government to pay anything on a structured transaction until the capital of the financial guarantor is wiped out.
Well, I get that, but that's the question we're asking.
So on a deal-by-deal basis, let's say on one deal, a financial guarantee company sells off 10% of the risk, the bottom 10%.
Right.
Okay. Well, investors take that risk. Well, let's say the risk get to be 20%. Well, the financial guarantee company is going to have to pay the 10% in excess of the first 10%, not the government. Okay, the government would only kick in if all of the capital for the financial guarantee company were wiped out.
No, I understand that. But the question is, you've got differential points at which the government kicks in if the trigger is by transaction or by structured deal versus if it's a mutual pool. And this is what Mr. Tracy was going to when he was talking about the vintage question. But the point is they trigger differently, which means, I'll put it this way, if they're priced the same, then the market will show us which one is giving a better deal for investors. Mr. Tracy, did you want to comment? And I'm now out of time, so
the key to the investor is they know that they're facing no credit risk.
Yeah.
And so that's important. The virtue of the vintage effect is that there's no uncertainty as to the amount of losses that the utility is going to take before the insurance kicks in. And then importantly, those losses can't spill into prior vintages. And so the capital that is being freed up from those vintages as they pay down is available for new lending, nor can those losses spill forward so that the guarantee fees on the new loans also will not need to be used to pay back any of those losses. So this helps to support, I think, lending going on even after a vintage may trigger. Now, what the threshold is depends on, again, how frequently do we think, or what circumstances do we want to call a systemic event? But I do believe that the optics are important. It's really helpful if the government is only paying out in a systemic event, not if a particular security went bad, not if a particular issuer went bad.
So I understand the point, and I'll just stop by saying, I get this. The question is whether or not these can all exist simultaneously, or the market will drive away from in effect, the mutual pool. All of this, it seems to me, affects the pricing of the insurance and ultimately the regulatory oversight, which would be very different in a pool than it would be, for example, in structured transactions. So thank you, Mr. Chairman. Thank you for your indulgence on that.